From the City of London for our viewers worldwide, Bloomberg Real Yield starts right now. Coming up, the stimulus effort breaking down in DC, ECB messaging getting a little bit confusing, and looking ahead to some messy politics. We begin with a big issue, the election 2 months away.
Higher volatility, a period of pretty significant volatility.
Volatility comes back in because of the election.
The US election coming up.
This election is like no others.
Lots of uncertainty.
Big if and when questions on fiscal stimulus.
The risk of obviously this sort of fiscal cliff.
The election risk premium.
We're a little concerned.
A higher level of underlying risk.
Very tough to make money in duration, whether it's treasuries or investment grade.
Credit and high yield would need to be reassessed.
Investors are just trying to be cautious.
We may have a contested election that might lead on for a while.
Joining us now is Jim Caron of Morgan Stanley Investment Management. Jim, great to catch up with you, sir. Let's just start with that big question on the election. So many things this year we've been told to care about haven't ended up mattering. Is the election any different?
No, well, the election is going to matter. I just don't know exactly when it's going to matter. So, yes, going into the election, clearly there's going to be some position squaring and there's going to be some risk that needs to be taken off the table. But when we think about both candidates, right, what the main driver for their economic policy is going to be, it's going to be the pandemic. Do we get a vaccine? Do we get a second lockdown? That's going to be the main driver. If we think of a Biden presidency, what we have to think of is growth coming more from the government sector, fiscal side, probably more fiscal expansion. If it's a Trump presidency, then it comes probably more from the private side. But either way, I think both politicians have a plan to generate growth. It's up to the voters to decide, which one is better. But both, I think, are going to matter. And the point that another person brought up earlier, which is that if there's a contested election, that's a problem. Because markets can deal today with uncertainty. That's volatility. We can price that. Ambiguity is what you get when you get a contested election. And if that's the case, markets do not like ambiguity. They don't like uncertainty, but they really don't like ambiguity. So that could be an issue, too.
Well, Jim, they've got the comfort of the Federal Reserve on their side. I've read some of your writing recently in the zero lower bound, the Fed's reaction function reimagined. Have we processed all of that quite yet, Jim?
I think we're in the process of it, right? So the way that I think about this is, many people say when they buy risky assets like equities or high yield or something like that, that you're short a Fed put, meaning that if the economy turns down, the Fed will cut interest rates and they'll boost those asset prices. What the Fed is doing effectively today is they're allowing you to sell an in-the-money put, something that has a little bit more premium. And what that premium is essentially a decline in risk premium for financial assets, for riskier assets. So what the Fed is saying is that they're going to allow, if there's good things that are happening in the markets and the economy is growing, they're going to allow the good times to run. But if something bad happens, if things start to turn down, the Fed is going to be very, very quick to react and move prices, and move policy in terms of liquidity, support facilities. They're going to act. So they're going to try to limit downside, but they're going to let upside run. So when you look at your distribution of expectations of outcomes for asset prices, it has to be skewed more to the upside. And that's why I say that the Fed is going from, allowing you to sell an at-the-money put to allowing you to sell one that's in the money.
Jim, what's the difference between what you're describing and an asset bubble?
So, effectively, the way that we have to think about this today is that the Fed does not want to cut rates into negative territory. So they're right up against the zero lower bound. We have to remember that the only way that the Fed acts on financial conditions is through financial asset prices. The Fed doesn't hire people. They don't start companies. They don't do any of those things. So the only way that the Fed can ease policy when we're at the zero lower bound is to create additional support for asset prices. Now, we can say maybe that's a bubble. Maybe that's a bubble in the making. Is it better than the alternative if the Fed has a much more negative or cautious look to the future? We're going to find out next week. The Fed's expectations for growth back in June was minus 6.5%. That'll probably be upgraded to maybe minus 5.5% growth. But still, this is a really, really bad year. And we have to recognize that the unemployment rate is still very high. So I think the Fed's nervous. So they would rather take the risk of a bubble today than not doing enough today and having a bigger downturn later.
So, Jim, I assume from what you're saying, you're embracing risky assets, embracing credit.
Yeah, that's right. So look, I mean, if we're at lower rates for longer, which effectively is what the flexible average inflation targeting is telling us, people are going to start to move into these asset prices. Sorry, into this asset class of credit. So when we look at this and we look forward into the markets, what the Fed is effectively doing is they're just trying to protect solvency. So look at corporate issuance. Corporate issuance is sky high, record levels. We've got 1.4 trillion in corporate bonds issued so far year to date. We issued 900 billion last year. We've got about 300 billion in high yield that's being issued year to date. We issued 290 in all of last year. In August alone, we issued about 54 billion in August. Third in quiet month. Third largest high yield supply month historically. What that means is that what the central bank is doing, what the Fed is doing, is they're embracing and allowing corporations to refinance and to fund themselves at longer periods at lower interest rates. And what they're doing is embracing solvency. What does that mean to a bond investor? That means that default risk starts to go down. So therefore, riskier assets like high yield start to look, pretty good, or lower in credit quality start to look pretty good. And by extension, you can maybe even say equity too, but that's somebody else's business. I'm a fixed income manager, but effectively the equity markets have responded positively to that.
Jim, you make it sound so easy. What's the key risk to this call?
So I think the key risk is really the pandemic. It's if we get another wave of lockdowns or a very big spike in the virus, there's not a lot more that can be done. At this point, the Fed really has to hand it over to the fiscal authorities and say, come on, guys, we need a bigger package. And ultimately what that means is that probably puts downward pressure on the dollar. What we have to recognize is that the big loser in all of this is the dollar. We've got a central bank that's expanding its balance sheet to almost unlimited levels if it wants to. We have fiscal deficit and debt to GDP ratios based on the Congressional Budget Office that continues to go up. At some point, this decline in the dollar should start to lead to inflationary pressures, but down the road. This might be 2, 3, 4 years away, but I think it can happen. So that's a risk. If that happens with yields so low and so much being issued, if yields start to rise, that could be a big issue.
So, Jim, that's the final question for me for this particular segment with you. When we wrap things up, you've made it pretty clear what you think is going to happen with credit. So let's just extend the argument just a little bit further to sovereigns. What are you expecting in Treasuries, considering how range-bound we are, slap bang in the middle of the post-April range at 70 basis points?
Look, I think that says it all, right? We've had equity markets correct. Look, the high-yield market since the March 23rd lows is up about 26%. And 10-year Treasury yields are absolutely unchanged. So think about what's happening here for a second. What the Fed is doing is they're trying to increase inflation expectations in the future, but at the same time, they're doing QE and they're keeping nominal Treasury rates at exactly the same levels, 60 to 70 basis points. What that's doing is it's pushing real yields lower. So real yields are at 10-year real yields are at minus 100 basis points, the lowest they've been, almost ever. So effectively, what that's doing is it's creating stimulus, but it's also a big signal for a weaker dollar going forward.
Jim, stick with us. I just want to quickly go through the week ahead with the final spread. Coming up next week, a busy week as well. We start, of course, with coming up on Monday, Eurozone and US industrial production figures on Monday and Tuesday. US retail sales, a Fed rate decision and Chairman Powell's news conference on Wednesday. We get rate decisions from the BOJ and BOE on Thursday, plus another round of jobless claims and the University of Michigan sentiment survey closing out the week on Friday. Jim, just to get to the rapid fire round, 3 quick questions, 3 quick answers, if I may. Let's start with the ECB. Is negative 50 basis points on the depot rate the end of the road for the ECB, or can they go further? Can they go further, or is it the end of the road?
I think it's the end of the road.
Second question for me on the United States. Will Congress pass a stimulus package before the election?
I think it's a coin flip, and my answer is going to be no.
The final one for me, and this has come up so much in the past week, will we have an election result on November 4th? Yes or no, Jim?
I'm going to say yes.
Jim, it's great to catch up and it's good to see you. You look well. Jim Caron there of Morgan Stanley. From London, that does it from us. We'll see you next week, Friday, 1 p.m. New York time, 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg TV.